Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is October 4th edition of Market Outlook. Don't forget to sign up for this free text and video newsletter, and you get it free every week by going to www.marketgauge.com and register for free there. All right, well, volatile week. Ended up closing the month pretty sharply down, which was the beginning of the week. The rest of the week and week to date, we closed, this week we closed about up 1% equally across all the indices. So let's take a look at some of the charts here. Number one, you can see the SPY, we're still in a bearish phase. It's where the 50-day is below the 200, and of course, the price is trading beneath the 50-day moving average. So looking at this chart, you can see after that massive mini panic where the market was down 1,000 points on August 24th and 25th, we've basically been trading in a really tight range for the last month. We attempted to test the true, really the true part of the range, which is the body of the candles, touched down on it, but held exactly about of where the opening was after the flash crash, and also where the opening price was the day of the flash crash. So you can see right here, the bodies of the candle and the low of this week, which is right here. Let me blow up this chart so you can see a little bit in more detail. So you can see the line that I'm putting in was the body of the flash crash day of down 1,000 points. That's where it opened. And the following day, it also basically opened at the same price and held those lows. So that low of last week is your critical hold point. Additionally, the upper end of the range here, where it closed at around 200.40, equals the 50-day moving average. So there are your two critical points. Obviously, we still have this declining 50-day moving average. It comes in basically at exactly the point where the market could not close above after the crash. Now, interestingly enough, if we move to the weekly chart, hold on, let me move this out here. We're going to move to the weekly chart. Another key point is that we have broken down under the 65-week moving average and starting to flatten out. So we definitely have some work to do. Above 203.70, the 204 level would start putting us back into a more positive view on the market. Looking at volume, you can see we had pretty good volume for the week. It was an up week, so that was positive. If we go back to the daily chart as well, you can see on Friday, we actually had an accumulation day. So that pretty much tells you the picture, and I think the SPYs are really a great way to gauge what is going on the support resistance levels. This is now a key chart to look at. We can take a look at the Qs just to see how that's setting up. Qs are a little bit stronger. We just entered the death cross a couple of days ago. Obviously, when you get a death cross and you're also quite a distance away from either the 50 or the 200-day moving average, it's not your greatest setup to start getting short. But meanwhile, we are also trading in this sideways range since the big drop as well. But one thing to notice, leading NASDAQ stocks, the Qs, certainly are holding up better as they haven't even come close to testing the gap low in late August, right? The gap low opening, which was around 95, didn't even get close to it. So the strongest index is the Qs. Obviously, the convergence here of the moving averages is something to be watched and followed. So move above 106.50 to 107, something certainly to watch there as well. Let's take a look at some of the market internals. In terms of the daily chart on the market internals, we've got the up-down volume, which is a shorter term, looking at over a week or so or more. And we did get oversold. We now are on a positive. So I'm looking at up-down volume as more of a washout and a positive for the spiders. McClellan oscillator just about touched down to an oversold reading and is bouncing nicely. Let's take a look at the advanced decline, still weak. So we've got 2 out of our 3 key indicators indicating a bounce is underway. However, we like to see all 3 in unison: up, down volume, overall participation in advancing versus declining issues have not generated a buy signal yet. So I would say market internals, advanced decline, up, down volume, McClellan oscillator on balance, positive, but 60 to 70% so in our favor to the long side. Taking a look at sentiment through the volatility ratio, you can see this is the VIX versus the short-term VIX versus the 3-month. Let's go to the daily chart. And again, you can see we're now hit pretty oversold levels on that sell-off. We had been attempting to rebound, cross the lower boundary of oversold or extreme exuberance on the negative side, but we're bouncing off that extreme level through that blue line, which indicates extreme pessimism, and now we're moving above that declining moving average. So again, a positive here. So we definitely got washed out, and it looks like we're getting somewhat of a bounce. So sentiment, market internals, a bit more favorable. Let's take a look at the calendar ranges as well on the spiders. And as you can see on the 1-month calendar range, which is basically looking at the first day of October, and then are we trading above or beneath it? And you can see we're now trading above the 1-month calendar range high. That is definitely a positive. So you got a couple of indicators here that are positive. Interesting, you can see gold here. This is a daily chart on gold. Look at this. Gold has now entered a recovery phase. We've been really acting erratically, lots of gaps, and not that much intraday action at all. So the daily ranges are relatively, the intraday daily ranges on COMEX and in the ETF here is very spotty. You can see a lot more intraday movement in the US in the past. Over here, much of the movement is overnight. Nonetheless, overall, you can see that the 50-day moving average has turned positive. So positive slope in a recovery phase. Let's see if that gold can help. But more interestingly is GDX. That's gold miners. Gold miners had a stellar day, up over 8% on Friday, and that was even in the face of bonds giving up a lot of their gains. Obviously, gold is very sensitive to interest rates, and even though the interest rates came off hard from the opening, the gold miners continue to move. Now, this is could be an extension a bit of things getting overblown on the commodity side, on the downside, especially with the major commodity stock, Glencore, having tremendous issues. Now, that's a foreign UK-listed company, and that has had tremendous problems. It's lost 60 or 70 or even more, 80% of its market value because it's heavily a commodity-based stock. Nonetheless, gold miners looking like a potential bottom. Actually, gold miners had some really good volume. So that's looking like a potential bottom in place. Also, gold and gold miners this time of year, seasonally, is when rallies do materialize. Interesting, leading commodity, sugar. This is something that we've been in for the last month or so. And that also had overall a really great move over the last couple of days, even while the market has been going sideways to down. So this might be an interesting harbinger of commodity prices in general. Oftentimes, sugar can be a lead indicator for commodities in general. So meanwhile, we're into this at pretty good prices. If you're interested in following our service, the Mish's daily service, Mish's Advantage service, we put people into sugar here. But meanwhile, this is moving nicely. You can see that the 50-day moving average turning positive into a recovery phase after just a tremendous washout. Yes, we are getting a bit rich on the RSI, but with something washed out as much as this is, there's potentially plenty more to the upside. All right, so that's a sweet chart. That's sugar. Let's take a look at one other chart, DBA, which is agricultural commodities, and DBA basing out here. So one of the things that we're definitely looking for is a potential move over that 50-day moving average. Now, I believe sugar is in this, but a small percentage. So sugar definitely leading the ags up. All right, well, that's it for now. Let's see how the markets unfold. We've got the trading range outlined in the spiders. We know the market internals are a bit favorable for maybe a continued bounce. Let's see when it materializes. In the interim, gold and gold miners, so bombed out, but looking like they're on a recovery move, and seasonally, it's the right time of year. That's it. Bye for now. See you next week, and stay frosty.